Yes, yes, yes. What's up, everybody? Welcome to CRL. It's Chart Request Live, the show where you provide the requests, we provide the charts. Spencer Israel here with Patrick Donawilla from the Chart Report. Pat, what's doing?
How you doing? I'm excited for this week's show.
You're always excited. I'm always excited. What's up, everyone? What's up, chat? What's up, Matthew, Wing of Tech, Yako? All right, you know the drill by now. If you have any requests for us, drop them in the chat. Although, if you want to skip the line in the chat, cut to the front of the queue, as they say over across the pond, email us. The email is at the bottom of the screen, questions at stockmarketmedia.com. Just put like CRL, chart request live in the subject so we know what it's about. And we will take your request on the show. So, for example, let's do a few of those now. We got a few emails since our last show on Tuesday. And we'll start with, what should we start with? Okay, here's one from Dan. CNM, Charlie, Nancy, Mary. I'm rusty on my NATO alphabet. I don't know what this one is.
CNM. Wow, who brought this one?
Dan. What is CNM?
Way to kick it off. Way to kick it off with a really nice chart here. Wow. So you can see here, it looks
Corn, like Maine. Okay.
What do they do?
Distributor of water, sewer, storm drain, and fire protection products in the U.S.
Okay, so I think fair to say it's like an industrial.
I would assume.
So you can see here, it looks like it went public. Maybe it was a spinoff. I'm not sure what the deal was there, but went public about 2 years ago in July 2021. And really hasn't done much in its life. You can see it kind of peaked here along with the rest of the market in January, December, about 2020, December 2021. Anyway, it's busting out of this giant base, or at least it's trying to here. And those are the post-IPO highs right there. If it gets above them, looks like it already is on a closing basis. Yeah, it is on a closing basis. I like this as long as it's above those late 2021, early 2022 highs. If you look at momentum over here, you can see this kind of bearish divergence forming. That is a little bit concerning. I think it's easy to see a bearish divergence and get really spooked out about it at first, but divergences can kind of diverge for a while before they materialize into any downside or upside. But this one, I think you just got to like it as long as it's above those former highs. Really nice base.
All right. Never heard of that one. Never heard of this one either. This is the ticker is AGRO, Agro. I want to say are they Brazilian? What are they? They are. They're a food company, agricultural company. I don't know where they're based out of actually, but and not one I'm familiar
like Brazil or something.
It might be. Here, let's see.
Yeah, it's not a bad chart. I put it in a weekly here to kind of get like a more zoomed out look at it. Still has some overhead supply here. You can see clear resistance at 13, which is also kind of the IPO highs. So you can
South American.
Oh, okay. Okay, yeah, but that 13 levels acted as resistance like 4 times in its life, and it's not too far away from it now. It's around $11 today, so it's got this little bit of overhead supply here to clear, and that's around 13. So if it does ultimately break 13, that would get me really interested. But until then, I'd like to see it get there.
Yeah. All right. That's the thing about resistance, right? It depends on how you look at it. It's either good that it's close, or it's bad that it's there again.
Right, exactly. These are inflection points, or as Steve likes to call them, he calls them levels of polarity. I've started using that too, and I think it's a good term. At first, I gave him crap about it because it just sounds like a fancy way to say resistance or support, but polarity is a really good way to think about these levels because it's not just always support. We have that idea of support turning into resistance and resistance turning into support. So these are levels where you tend to see inflections or big decisions among market participants around these levels. So
Yep.
I think that's kind of a good way to think about it.
Yep.
Levels of polarity.
All right. This next chart doesn't look nearly as good as this first two. USB, US Bancorp.
Okay.
They you know what? Actually, they're having a pretty good month here.
Yeah,
So
not the worst. I mean, a lot of those regional banks have made a really nice comeback. I think that's helped the Russell rebound a little bit in the past, like basically in July. Russell led by a really nice margin there in July. So these regional banks, they're getting their act together slowly. On a relative basis, there's still a lot of sectors that I would personally rather be in. But this one, you can see it found support here at the COVID lows during the banking crisis earlier this year. That was right around 29. It actually kind of had a little fail breakout there, which is nice. I mean, I think seeing that this move started with a failed breakdown at a major low, like the COVID lows, that to me tells me that this could keep going. This could, keep busting through resistance. You got short-term resistance right here around 40, and that's the October lows. And then you want to see it break this downtrend too. If it can break this downtrend line, I think that would get me a little bit more bullish. Maybe you see a little bit of a upside acceleration after that's broken, but still has a lot of work to do. But like you said, I mean, it had a really good month.
Yep. Here's a financial that has not had a particularly good. Well, I mean, maybe the month is okay, but today not so much. PayPal. This is a bit of a disaster. It's all gone wrong here. Down 11% today. They did have earnings after the close yesterday. That's why it's down today. I'm not gonna pretend like I have dived deep into this earnings report. I haven't. I can tell you what the numbers are, but the numbers are irrelevant. Just look at the price action. That tells you all you need to know. So whatever they said, the street hates it.
Yeah, so this one you can see I've marked it up before. So this is a long-term trend line. And we've talked about this before, this was a really key breakdown area right here around 125 here. It was both the trend line break and this horizontal support from the pre-COVID highs, the 2019 highs. So this was a pretty key level, and we're far away from testing it. I'd imagine if we do ever get there, that's going to be pretty significant resistance. But you can see this was also support here around $68. It's been acting as support for pretty much the past year. We tested it last summer, again at the end of last year, briefly broke through there. You can see in May of this year, it was it looked like it was trying to do a failed breakdown here, but here we are. You said they had earnings today, right?
Yeah, yesterday.
Yeah, so stock is back below that support level there. If it's under 68, I mean, that's pretty brutal there. This thing just can't catch a break, huh?
And if it's under 58, which is the low from a few months ago, hold on to your hats.
Yeah. I guess we can go ahead and delete this little fail breakout because it never really materialized, right?
Yeah. Gosh, this stock is trading at the same price. Could have bought it at the same price basically 6 years ago. 6 years ago, you could have bought this thing for the same price. So
brutal.
Yeah. Investing is hard.
This was one that used to be in the technology sector that I believe they moved into the financial sector after the banking problems earlier this year. They did that one, Visa and MasterCard, I think, maybe a couple others. But I thought that was kind of interesting. They reclassified this one.
I thought the credit cards were always financial. I don't know. I just assumed.
No, so they were actually tech for a while, which never made sense to me. Visa and MasterCard were both tech for a while. PayPal, they were fairly big in there too.
PayPal might be in the financial sector, but to me, it's a tech stock. It trades like a tech stock.
Yeah, I would agree with that.
Yeah.
I mean, look who the founders are too, right?
Yeah, right. Okay. All right. Yako speaking my language here. Okay. I have an interesting long-term analysis for you. Can we look at the QQQ versus the SPY and the QQQ versus the diamonds for long-term retirement portfolios? Seems like the Qs are the move. Well, let's take a look at the Qs SPY and the Qs diamonds. and see if we agree.
All right. So I like this. This is a good exercise here. I removed my drawings because I want to take a fresh look at this thing. And when it comes to these ratios, anytime you're using the Qs, you always want to zoom all the way back out to the dot-com bubble highs and see where we are in relation to those.
Oh, man.
And again, this ratio that he brought up is the NASDAQ relative to the SPY. So in case you're not familiar with ratio charts, if the line's going up, it means the numerator is outperforming the denominator and vice versa. So in this case, line goes up, that means NASDAQ is outperforming the S&P. Now you can see we only broke out above those dot-com bubble highs in favor of the NASDAQ in post-COVID, basically. And we've kind of struggled with this area ever since. And it makes sense. I mean, those were really, really historic highs there. And it makes sense that we're kind of seeing some slop around that. But you can see kind of held and then broke down. That's when you saw growth and tech really getting hit last year, just this little down leg. But quite the rebound. Here we are back towards all-time highs. If it breaks those basically 2021 highs, you got to imagine that we're in an environment where growth is working, tech's working, and probably a risk-on environment. You know, if the NASDAQ, which is a little higher beta than the S&P 500, if that's outperforming, we're probably in a pretty good environment. Just like last year, when it was underperforming, we were in a pretty tough environment.
Yeah, I always love this chart. I love how just how smooth the trend was the whole last decade, and B, how choppy it was the decade before that, right? Obviously, you had the dot-com bubble burst, and the bottom wasn't until 2003. But from 03 to 08, it wasn't as if, the SPY crushed the Qs. It really was like just back and forth.
That's a really good point. And I think that's just something to keep in mind with any of these like longer term trend changes, because you're seeing that this year a lot in a lot of stocks where they've had this massive decline, right? Like pretend this is last year. Like a lot of charts have that massive decline, whether it's PayPal or a lot of those ARK stocks or a lot of the hot SPAC stocks that were big in 2021. Anyway, so that's the phase we're in now, that 03 to 08 phase where we're trying to form a new uptrend, and it's just messy. You see all these starts and stops. We're not going down to retest the lows on a lot of these stocks that are trying to repair, but it's not the same kind of momentum that they enjoyed on the way up. So I think that's a really good point, kind of that messy base building process where you're trying to establish a new trend.
All right, now let's look at the Qs versus the diamonds.
Cool.
And we know these. First off, if you're even asking these questions, then you're probably wrong one. If you're asking these questions, you're in a good headspace already, I think. So I think if you're really deciding between the three major indexes, you're probably splitting hairs a little bit. Frankly, if I'm being totally honest, they're all pretty correlated. Obviously, some outperform and some underperform over certain time periods, but as we just showed you, it's always changing. So this one looks the same.
This one looks the same, but you can see it's kind of being rejected, and that's probably a function of the Dow's recent strength, and kind of the NASDAQ just pausing in the last few weeks. You've seen that relationship kind of get flipped on its head, but all year it's been the NASDAQ. I mean, last time I checked, NASDAQ was up like 44%. It's just crazy. And Dow, I think, is maybe like 6%. It's a little lower beta. So this is an interesting look. If Dow's outperforming, it's kind of saying something different from that last chart. So it is a little bit interesting here. Obviously, I think it would be more bullish for the market. We'd probably be in a more bullish environment if we broke out of this ratio in favor of the NASDAQ.
Yep. I would just say with regards to the Qs is based on past performance, you'll probably get better returns, but you will almost certainly have higher drawdowns as well. So just make sure you can stomach that drawdown. If you can, then great. If you can take it, then have at it, right? Right. But the NASDAQ will certainly go down harder than the other two will, just because the beta that you mentioned.
Real quick, I was thinking about this yesterday because a few years ago, and this just randomly popped into my head yesterday, but I remember talking to a financial advisor of all people.
Yeah.
He's a friend, but he was saying that in his personal account, he just basically averages down on TQQQ, which is the triple leverage
What?
NASDAQ
Get
ETF. This is
out
a
of here.
financial advisor, Spence. And he
Oh
was
my
like, yeah, I mean,
gosh.
over time, it's just going to go up. You got to sit through some really nasty drawdowns. But I mean, why buy the NASDAQ when you could just buy this? I'm like, oof.
All
I
right,
was thinking about it yesterday.
look,
I was like, I hope he's doing okay.
TQQQ, I guess, is okay if you don't mind losing 90% of your money.
Right.
And also, it only works in an environment when the NASDAQ is going up consistently. It has to trend higher. That's the thing. It has to trend. TQQQ is not old enough, I don't think. No, I think it only came out in 2010. So I guess we could backtest it, but we're not going to do that now. If you owned the TQQQ from 2000 to 2008, you would have gotten roasted. You would have gotten roasted, right? It only works when the Qs trend higher, right?
Right.
Like,
I mean, so I think NASDAQ suffered a 33% drawdown last year. I can't remember exactly what it was. I think it was around there. Yeah, it wasn't any more than 35%, but this thing fell 80%. TQQQ. So yeah. In a bull market, you look like a genius, but painful. I mean,
that's tough, man. Holy
80
cow.
cents on the dollar that you lost in a year, and it's still down 50%. So
yeah. It's all fun and games till you get punched in the mouth and down to 80%. All right. Back to the chat. Somebody asked us to look at energy. What else is new? They dropped Chevron and Exxon in there. So
sure.
Put either of them. Doesn't matter. To me, they're one of the same, honestly. I know Steve likes Chevron more. So does JC, I think. But I don't know. To me, they're kind of the same thing.
I agree. I mean, if one of them is gonna work, they're probably both working, right?
Yeah.
So long-term look, you can see I've already had it marked up here quite a bit, but so ignore some of these drawings here. That bearish divergence did kind of play out, but here we have it. It broke down from this trend line. That's okay. To me, a trend line break is more like our friend Ian McMillan, he calls it the rate of trend. I like that. He calls trend lines the rate of trend because it kind of is like that, kind of the rate of growth. So maybe it's not going up at the same pace as it was off the COVID lows, but this thing's still trying to work higher here. Crude oil, energy, that whole space is just really firming up. If you look at gasoline's been really strong, even stronger than crude oil. So this one, I think you want to see it regain these April highs here around 161. That's like near-term resistance. Then you're looking at the all-time, I shouldn't call it all-time highs. Yeah, it is all-time highs, around 186. But not too far away, still in an uptrend, still trying to make higher highs, higher lows. Now, this is a weekly. We can go into a daily here. You can see it really hasn't done too much in the last couple months, just kind of flattening here. But I would expect the path of least resistance to be higher here. If you look at this level here, what was momentum doing during that time? It was improving and it wasn't breaking down. It tested this 150 level since March, probably at least three times. Each time momentum just got, it just made higher lows there. And you can see it wasn't even getting oversold on its last few attempts to break that 150. So I think this chart works higher ultimately. And then you said the next one, Exxon?
Yeah, I mean, I'm sure it looks the same.
Yeah.
So
yeah, similar. You can see this kind of just hasn't done too much, which is interesting because you'd expect, like crude oil was just hitting 3-month highs, and this thing, you don't really see that type action. Although the stocks were holding in a lot better than crude oil over the past year or so. So maybe crude oil is catching up to the stocks, or maybe they were already pricing some of that in, and maybe they'll continue to catch up. But this 108 level has also been tested so many times that you got to imagine it's just a matter of time before it ultimately breaks higher and we go towards that 118 level there. But in terms of what I'd rather between the two, I think I'd rather ExxonMobil.
All right, there we go. Let's stay here for a second. CNQ, Canadian Natural Resources. This one looks interesting. It's just this is just bunching.
Oh wow!
So, yeah,
fantastic chart.
I like this.
Wow. Okay. So zooming all the way back here, we're going to put in a line chart. Maybe you guys can see it a little bit better that way. So starting off all the way to the 2000 and looks like 2008, 2007 highs, right around $50, nice psychological level, 50, 51. And so you can see we broke out above those former highs. That was like a decade-long breakout last year, which is funny because that's when the market was peaking. Energy stocks, that's when they were just starting to break out there, or at least this one. So ran to an all-time high of 67 here, and then pulled back. Let's go into a daily now. So this is that 50 long-term level here. You can see a few false moves below it here. They were very short-lived here. This was like a little island. Look at that. You got the gap down, gap up, little isolated price action down here, and you got the ripper higher. Another short-term level right here that I think needs to be dealt with, and that's your immediate resistance. We're testing it right now. You can see 1, 2, 3, 4, 5. This is like the 6th time we're testing it here. If we can break above this 62, 63 level, that gets you to a test of these all-time highs around 70 here. But I think this one works higher. I mean, you can see it's just knocking on the door. Knock, 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 knock.
Yeah. It's fun when charts bunch up like that.
Yeah.
Because it makes you think maybe it's going to break out in one direction, in either direction, and then we'll know. We'll have resolution. But this chart,
it's that kind of disagreement between buyers and sellers where they've kind of reached an equilibrium point, and then one of them is going to budge, and then usually you get the resolution in that direction.
Who blinks first? Okay, a couple of very different looking charts from Daniel in the chat. First one is Planet Fitness, PLNT, which if you just take out the COVID low and take out the post-COVID bubble high, this thing is, speaking of trading in a range, this thing is stuck basically between like 50 and 85 or 90 for a good chunk of the last 3 years, 4 years even.
Yeah, I see what you mean there. Like right here, basically.
It's just stuck there.
55 has been a pretty key support level. Obviously, COVID, that was its own animal. That just blew through
I know
a lot of things, and it created a lot of headaches for us chartists. But you end up dealing with it, and you end up figuring out how price reacts to those kind of weird levels there. But anyway, like Spencer said, really range bound. And this one, when we zoom out like this, we could even put it in a monthly. You can kind of see that kind of looks like a distributive topping formation here. We always draw big smiley faces on our base or on our charts when we see a big base that we think is going to resolve higher, but this is kind of a topping base.
Mm-hmm.
We don't talk about those as much, but it works the same way. I mean, we could kind of do a fun little exercise here where we invert the scale. So,
oh yeah. Well, now it looks pretty good.
Now it looks like any other ARC stock, doesn't it?
Yeah.
It actually really does, which is funny. But you can see, if this was, I would be bullish on this chart here because it is forming this nice base. But if you're bullish because we inverted the scale here, you're actually bearish. But that's kind of a good exercise to do to kind of remove the bias that you might have.
That's good, man. I like that. Yeah. I agree with all that. That was really good. And then the other one was Honeywell, HON, which looks very different from this chart.
Is this one still in the Dow, or did they kick it out?
I thought it was still in the Dow. I could check, but I won't.
This one's kind of a mess. You can see, I liked this downtrend breakout here. earlier this year, and we got the retest. We kind of threw back to it here in March, took off again, but then just can't catch a break here. Just really slow momentum. And a lot of these names, they might look okay, but on a relative basis too, they're probably just a mess. Here we have Honeywell versus the S&P 500. You can see it's breaking down to multi-year lows, or at least testing these February 22 lows. So really, really hard to like this one. Maybe if you're a long-term person or a dividend person, it might be more attractive to you, but with so many other areas of the market working, it's tough to get too excited about a big name like this.
All right. Didn't see that coming from you, but that's why we do it. That's why they play the game.
That's why we did it.
We got a couple more here, and we got a couple more minutes. Let's rip through a few of these right now. Okay, Jan, Open Door. I guess you've had a good 2023. You could say that.
What's the ticker?
It's Open, OPEN.
Now, is this it's like a LinkedIn almost? It's like for hiring, monster.com almost?
No, this is
that's Glassdoor I'm thinking of.
That's Glassdoor. This right. This is a like a real estate listing buying and selling platform. Do you remember that they went viral for like the wrong reasons? Remember they like fired like half the company over like an email or something?
Oh my gosh, no, but I'm definitely gonna look that up after
a couple of years ago. The CEO got axed, I think, when that happened. It was a whole thing.
Do you mind if I just interrupt real quick? Something you said reminded me of this, and this is the funniest thing ever.
Yeah.
So my friend Arun Chopra, a lot of you guys probably know him on Twitter. He's got one of the most clever, hilarious feeds out there. This is one of his favorite market facts. So the day Zoom peaked was the day that CNN anchor pulled his out on TV. Do you remember that?
No, Jeffrey Toobin?
Yes, that was the day Zoom peaked, and before it was just exploding. That was the day the thing peaked, and it has just been downhill ever since. I mean, so anyway,
correlation does not equal causation, but that is a fun fact. That's a fun fact. All right, there. Back to the Open Door.
Back to Open Door, yeah. I'm going to look up that little scandal after this, the email one you were talking about here with this stock.
Just Google Open Door, like fires or Open Door layoffs, and you'll get it.
Oh, I'm sure I will. So this one, nasty downtrend here. One of these that went public during the growth kind of SPAC mania that was 2021. It's just had a rough go of it. Anytime it's below these IPO highs, with any IPO, with any stock that's gone public in the last few years, you want to start when you chart, you want to start all the way out to those IPOs and look, is it above the IPO highs or I'm sorry, above the IPO price or below? If it's below, there's really, it's got a lot of uphill battle to fight because it's just got a lot of overhead supply. A lot of these companies, it seems funny. Going public as a company used to be a way to raise capital. And it seems like in the last decade or two, it's become this liquidity event for a lot of these companies that get bid up in the private market. They go public, and it's more a way for them to kind of get cash for this company they've built that they've been told is worth billions and billions of dollars. So I think the IPO process is a little bit different from how it used to be. But bottom line is when it's below those IPO prices, you're fighting a lot of overhead supply that buyers have to absorb. So this one's fighting an uphill battle here. Not saying it can't do it. I mean, we're talking about a stock that was at $1 last at the start of this year, and now it's at $4. So very, very considerable progress here, but I'd like to see it above 10 ultimately before I get really interested. Let's look a little bit shorter term here. A lot of stocks are dealing with this bearish momentum divergence right now. Even the S&P and some of the other major indices have a little bit of a bearish momentum divergence. Now, those things can persist for a little bit before they actually take hold or before you see a meaningful downside. But this one, it's coming into this. I would say this is kind of resistance here. You can see the last year we kind of skated on it for quite a while before we initially broke down. So now we're revisiting it after, up 400% or whatever it is this year. I could see it working down here a little bit, and kind of goes back to what we were talking about that frustrating basing period where things are trying to establish a new uptrend. And that's a really frustrating process. And given this thing's up 400%, I think you want to be careful on this one in the short term. Maybe it gives you a chance to buy it here at these highs from earlier in this year around $3. So I would rather be a buyer right down there.
You're absolutely right about the IPO thing. It's been a known phenomenon going back for like a decade now, as companies were been waiting longer and longer to go public. And then a whole bunch of them they jumped on that gravy train in 2020, 2021, 2022. They jumped on that gravy train while they could. But yes, this is a known phenomenon. As the private markets have gotten more robust, there's no incentive. You can just raise money in the private markets and have zero price transparency and and your stock will never go down because you market once a quarter. So who cares?
Yeah. And another thing that I've kind of realized through that whole thing is, we think of VCs as these polished, sophisticated investors. But one thing we've learned in the last 5 years is that they're subject to a lot of the same investing biases that we are as traders, whether that's piling into something that everyone likes, like a Theranos or, the popular startup of the day. I'm sure we could name a ton of them. FTX was kind of one of them for a little bit. So it's kind of interesting to see that a lot of those same herding mentality, things like that, the psychological biases that we see in public markets totally apply to these very sophisticated investors in private markets as well. I thought that was a really interesting thing we've observed.
We're all just fumbling around here in the dark. That's all we're doing. All right, guys, we can't get to all these in the chat. We're going to have to call it today. So come back on Tuesday. The show airs every single Tuesday and Thursday, 1 p.m. Eastern time. Who knows? Maybe we'll get to a point where we're doing the show more often, but for now, we're going to stick with the twice a week thing. It's working for us. Any questions? You want to get your requests in early? Email them. questions@stockmarketmedia.com. Put CRL in the subject. I think a few in the chat can attest to the fact that I do check my email and I see, and I write all the textures down that get sent to us. So that's my recommendation. Pat, have a good one. Everyone, have a good one. Smash the like, subscribe if you haven't already. We'd appreciate that. And we'll see you tomorrow.
Yeah, thank you guys for all the great requests.
All right. Bye, guys.
Bye.